Forex is the most traded market in the world by the new traders, and it's also the most misunderstood. Brokerage industry won't tell you this. They sold you fast money, leverage and a dream. What they never told you is that the Forex is actually one of at least transparent market out there. It trades completely over the counter, no central exchange, nothing. So in this video we're not going to trade it like a casino, we're going to actually understand it. We're going to break down the real fundamentals and what generally makes a currency move. Let's go. Quick basic first. Forex is the currency market. Every pair is just one currency priced against another. The euro against the dollar, the pound against the dollar, what traders call the cable, the Aussie dollar against the dollar, Aussie, the New Zealand, Canadian, Japanese yen, and you can mix and match them however you like, euro against pound, pound against the Canadian dollar, and on and on. When you trade Forex, all you're really doing is betting on the exchange rate between two currencies rising or falling. So if euro USD is sitting at 1.15, that means 1 euro gets you $1.15. If the euro gets stronger than the dollar, that pair goes up. If the dollar gets stronger than the euro, pair goes down. Simple. But here's the real question, the one almost nobody can answer properly. What actually makes one currency stronger than another? The main drivers of the Forex market are central banks, interest rates, and bond yields. This is exactly why you can't skip macroeconomics. If you're trading Forex CFDs on MetaTrader or some prop firm with zero understanding of the economy, this is going to flip a switch in your head, hopefully. Let's use Euro USD as an example. So the central bank for the euro has interest rates at 1% and 1 year bond yields around 1.5%. Now the dollar, say the Federal Reserve has rates at 5% and US bond yields are around 5.2%. Now ask yourself a simple question. If you had to park your money somewhere safe, a bank, a government bond, somewhere to protect it from inflation, which would you pick? Euros paying you 1% or dollar paying you a fat 5%? Obviously the dollar. Higher yields, easy choice. And that's the whole point. The fundamental driver of Forex is the spread, the gap between the interest rates, the gap between the yields. Money flows towards where it gets paid more. Hopefully this one makes sense. And because of the spread, something really clever becomes possible. Watch this. I can borrow money in the currency with the cheap interest rate. Say I borrow at 1%. Then I take the money and I lend it back out there and it pays more. I buy US government bonds paying 5%. So I borrowed at 1%, I'm earning 5%, I just made a 4% return for basically doing nothing. That's called a carry trade. You exploit the interest rate differential. Borrow cheap, lend expensive, usually by buying government bonds, and pocket the spread. The most famous one in the last 2 decades was the yen carry trade. The Bank of Japan kept interest rates at basically zero for something like 30 years. So imagine borrowing yen at nearly 0%, then buying any other bond yielding 5%. That's close to free money, and this trade got enormous. It's a great case study too, because when it started to unwind in August 2024, it shook the yen, the dollar, and the stock markets all over the world. Let's go back to the chart. So the spread between two currencies, interest rates, sets the trend of the pair. But here's the part that catches everyone out. Remember how the stock market anticipates the economy? It moves before the news. Forex does this exact same thing. The smart money isn't trading today's spread. They're trying to predict what the spread is going to be. If they expect euro rates to rise and dollar rates to fall down the line, they'll start buying euro. If they expect euro rates to rise and dollar rates to fall, they'll start buying euro USD 6 months early, long before it actually happens. They priced in ahead of the time. So write this down. It's not the current spread that moves the market, it's the market's expectation of what the spread will be in the future. So how does the market try to predict it? It's not complicated. Inflation and employment data directly drives monetary policy, and monetary policy decides interest rates and bond yield. So every time fresh inflation or jobs data drops, the market reprices its expectation. And here's what the big moves come from. When inflation and employment data start pointing in one clear direction, a direction that market is already betting on, that's when the real trend happens. And that's when Forex actually moves. So next time someone tells you Forex is just lines on a chart and a gut feeling, you'll know better. Underneath every move is a story about interest rates, yields, and what the smart money expects next. Understand that and you stop gambling, you start trading. We do this every single day over in our Discord, just a room full of traders learning to read the market for what it actually is. It's completely free to join on our free channel and the link is in the description. The market's hard enough on your own, so don't trade it on your own. Come learn with the people who think the same as you do. See you inside.